Alright traders, welcome to the TMT Stock Market Strategy video for Monday, December 5th. Alright guys, so we had a very quiet Friday going off of the non-farm payroll numbers, and that's you could just see that the momentum from the Trump rally has now starting to subside. We are coming into a seasonal time of weakness for 2 weeks, and then we get the Santa Claus rally towards the end of the year. Last year, you have to be careful, because if history does repeat itself, and usually it does, I mentioned this in many videos ago, we have interest rates that are rising. Same thing with debt like we had in November and December. And late December, I believe it was the 27th, 28th of December, we started to get a market sell-off. And then we went into January of 2016, and we all know what happened. 8 days of consistent selling down, probably about 8 or 9%, the beginning of 2016. Does that happen right now? Not sure, but we need to be cautious. We also have deterioration of the internals, the breadth of the market. We have divergence forming in a lot of the breadth indicators that I follow within our TMT trading model. And we have price moving up on very, very low volume. Well, that hasn't happened the last few days. We had some really good trading days with market behavior and internals, and Friday was very quiet, but I do suspect the volatility to pick up yet again. Overnight we had the Italian referendum, and just again, what a fiasco. The markets sold off. I actually opened at 6 o'clock Sunday night. Futures opened down, and then all of a sudden Renzi quits, and market rallies right back up again. So again, the pundits and of course retail are conditioned to continually buy the dip. At one point in time, that's going to fail. So that does not mean to go against the grain. It just means that we're in a very high level of risk at the moment, okay, especially when markets are fully valued. Okay, so just again, please use caution when you're adding to your longer term portfolio. When you're day trading, it's different. You're at the end of the day, you're finished, you're flat. There's no real risk exposure out there. Just quickly, I want to talk today, and I try to move things around between bonds, gold, and oil, because we have a short video. So today I'm going to focus on oil. A lot of emails requesting an oil overview, so I'm going to give you that. I just want you to be aware that bonds right now, we have the treasuries the most short in 6 years. Okay, so that does not mean, again, it's a buy signal to buy bonds, but at these areas, and the way bonds have just literally deteriorated in the last let's say 2 to 3 weeks prior to the Trump rally, you have to use caution, and you have to be careful, and maybe an opportunity, be opportunistic, to look to possibly get a buy signal in bonds, which would be via the TLT if you're not trading the ZB. Okay, all right. Now, as far as oil is concerned, took a look at the commitment of trader reports, and the producers, which are the smart money in that report, are the least short right now as far as oil since August. Okay, so that means that they're starting to pick up their positions. They're always hedged, but they're not as hedged as they were from back in August. So that tells me they're starting to build their hedges back up at these areas. So 52, 55, we're at about 52 now in the pre-market. A little bit more to go. We can get to 55 in a matter of days. I think that we're not there yet, but we're almost at a market top in crude oil. It needs a lot more work, and in front of you is the bullish percent energy sector. Okay, the BPE-NER, we're at 86%. So 86% of all stocks, based on a point and figures chart, are on buy signals. Okay, so that tells me use caution. We also have the RSI at 78. Of course, MACD and stochastics are extremely and grossly overbought. So looking for an entry on a short side, not there yet, but just keep an eye on that. Okay. Next is going to be crude oil itself, and you can see the WTI. You can see we have an ascending triangle here, right? I mean, if we do break out to 52, we'll probably run up quickly to $55, $58, and we're there now. We're basically at 52.22 right now. I'm probably going to take out this little interim swing high. Okay, so definitely not telling you to get short. And again, remember, we've rallied very, very quickly based on the Vienna meeting with the OPEC members and non-members cutting production. So just again, looking for a short, not there yet. Okay, we are not looking to short crude oil at the moment, but we are getting to a point where we're going to get into those washout levels of overbought state. Gold, let's talk about gold real quick. Gold here is at that 61.8% retracement, and you can see that thin zone. I placed the volume profiles on the side, and just to show you that if we lose this area, which right now we're trading at 1163, and that it has been lost, we should flush right back down to about 1100. Okay, and then we would reevaluate again. But I'm looking for a buy-in in gold somewhere around this area here. Let's go right into the GLD, and you can see here again, thin zone, looking for that 76.8% retracement hold. And you can see, guys, this is based on our premium pro trade premium video. Just wanted to show you guys some of these levels. These are off the daily, but we give you intraday charts to trade off of support resistance areas, and you got to come check it out. It's a great little tool for very, very little money to assist you during a trading day. Anyway, back to here, you can see these are your levels for the trade. I'm looking for that flush back down here into the 106 to 108 area in GLD, and then looking to possibly buy and enter GLD. Next, GDX, same thing. You can see here, you can see clearly we have big support area here, 61.8% retracement, and of course that $20. If we lose that, we're looking for $17 to $18 back in GLD. We're starting to get a little positive divergence in our MACD and RSI, so just keep that in mind as well. Next is the indexes. You can see here we had this big bearish rising wedge. Okay, we did trigger, and the wedge was negated because we're back into the wedge now. These are your areas off the daily chart. Okay, the 212.50s coincide nicely. By the time we price whatever to get down there, we'll be at this area here. But you can see what happens. We rolled over, and our MACD and RSI gave us a sell signal in RSI. Not quite on the MACD as of yet, but you can see we have bigger distribution days than we do accumulation days. Okay, so this is just all algos just running amok here. So just be careful, guys. 60-minute, we mentioned about the gap fill area here, so we did get that gap fill area. So our next target's going to be back down into these areas here at 218 to 217 and a half, and you can see that we have our MACD and RSI just consistently making lower lows and lower highs. Okay, next is going to be the IWM, and I just wanted to give you some downside targets here. We hit the 21-day moving average, at 130.90. So the 38% retracement is going to coincide nicely with this long-term uptrend line from January lows of 2016. Okay, to get us MACD sell signal here, and we had an RSI sell signal back up in here about several days ago. And lastly is going to be the Qs. We have obviously rotation coming out of big cap tech, and remember, if we're looking for another leg up in the markets, big cap tech cannot really take that much of a hit, okay, before we move lower. But this is fine. I mean, this is to me normal. Markets need to rest, pause, and pull back a little bit before you make another leg up. Can't just go and rally like we did here. I mean, it's just insane the way the algorithms in the high frequency trades really affect the markets, and they give you a false read, and that's where our DPI indicators and our dark pool trading room come into play. So come check us out, guys. TradingMarketTechnicals.com. Have a great trading day. We'll see you tomorrow. Take care.